The topic for today's session, if I might summarize what was a long topic, I would say it's about new business creation and what will get unlocked as opportunities for business and what comes in the way and what are solutions to. That's a bit of how I would treat this panel. Maybe just a few opening remarks, again, to frame a bit of the opportunity challenges at a high level. But the panelists will really, I hope, talk about it in more depth. Um, I think the net zero transition, net zero or zero, however you call it, basically, if we are to accomplish it by 2050, will require about $9 trillion of annual capex, which is about 7.5% of the world's GDP. 2.5% of this, of the world's GDP, will be new capex. That's capex that would otherwise not have happened. And that's because this revolution is more capital intensive and less OPEX intensive. The number for India is in the range of 4.5 to 6%, and that's with a 2070 net zero. Just to put this in context, 4.5 to 6%, let's say 5%, we invest about 30% in our economy of our GDP, in our economy. That's the context. And effectively, in this decade itself, our clean investment needs to go from somewhere between $40 and $45 billion to about 104x, $160 billion just for India. And that's also because 80% of India of the future hasn't been built yet. And that's an opportunity for us because we have to talk less about decarbonization. We have to talk more about growing India. And that's the reframing a little bit here. Now, there are four transitions that open up the opportunity. There's the energy transition, the materials transition, that materials consume a lot of energy, emit a lot of carbon. There's the mobility transition, and then there's the agri and land transition. And so opportunities are there in all of these areas. I'm sure we'll hear about some in a moment. A lot of the spend, about half today, is from the public sector or the governments. Only about half of what's being spent globally is from the private sector. So in a sense, the share of the private sector, and this we heard in many other panels in the morning, Mr. N.K. Singh talked about it, the private sector share needs to rise dramatically. And let me just frame that in company context, right? So our assessment is that there are about 5 to 15 decacons, climate decacons that have got created in the last 6-7 years, 130 unicorns. And these can be new companies, these can be spin-offs from old companies, all of those. Probably a little bit of an underestimate. We probably haven't been able to count everybody. Yet it's complex, huge scale up, many places where technologies are not developed. Hence, there's a strong role for regulations, which may or may not be moving quickly enough. Capital costs have gone up in the last year. We've seen that, and that's led to many sectors like the wind sector, offshore wind sector, particularly across the globe, is hurting really badly. Many others are. There's an arms race with CBAM and carbon price in Europe and the IRA in the US, the arms race that started. So many challenges, which then frames the main question for the challenge, right? How do we increase the private and business involvement in this new revolution that's coming? That's the main question. Let me open this up. I'll just go around quickly with the question on what opportunities do you see for business? Let's start with you.
Okay, thanks, Rajat. So, as you know, I'm part of IFC, who has been active in India for many years. So we were initially involved in renewable energy and financed the first solar wind project way back in 2005-06. The world was not even looking at it. And having seen that journey and seeing all the hiccups and the good things on regulation and some of the bad things, I think there are a lot of lessons that can be applied to the new opportunities that are coming up our way, and at least within India. So some of the new opportunities that we are seeing and we are pursuing are obviously on electric mobility, on energy storage, even though it's a little away from commercial viability, but we are seeing early offshoots of that, and we can look at that. Recently, we have also financed with industries and with companies using sustainability-linked loans and sustainability-linked bonds. First time in India, these have been done where what we do is we finance companies with clear measurable targets and some incentives and disincentives for achieving or not achieving it. It's not perfect. There are some lacunas there. We want the incentives and disincentives to be large enough the carrot and stick to be large enough for it to create a momentum. But I think it's happening. Then other areas where we are seeing early opportunities, and IFC is actually taking some of the initiative there, is on ESG in the SME side, the scope 3 reductions. This is still a huge area, yet untapped. A lot of data is required there, a lot of disclosures, data monitoring is required. But India's DPI and India Stack backbone gives rise to innovation that can happen on SME. Another area is green buildings. And I think your report, Rajat, on India decarbonization clearly talked about how buildings contribute a big way to the net zero plans. And at least IFC is taking a lot of lead in green and affordable housing. And not just green and affordable housing, even on the commercial side. How do we improve energy efficiency, water savings, building materials, circularity, all these to get to that. Bottom line is, if there is risk, if the risk return matches, which is the fundamental of corporate finance, then money will flow from the private sector. But if that doesn't happen, then no matter what we talk about.
Let's come to the challenges in a moment.
Okay, fine.
Yeah, so I'll come back to that.
Okay, so let me stop with opportunities, and these are the new opportunities that we are seeing.
Uda, what opportunities do you see from your vantage point?
Thank you, and thanks everyone for having me here. I work with GIZ in the transport sector, so I'll be speaking from the transport angle. And so transport at around 11% of final energy consumption in India. Definitely without decarbonizing the sector, it would not be possible to achieve a successful energy transition. And so we see two things here. On the one hand, the demand is actually growing, and we need to decarbonize it at the same time. Plus, at the moment, it's largely fossil fuel, oil products, but we are seeing this great shift towards electricity. So there'll be an increasing demand for renewables, for electricity, for the transport sector in particular. So when we talk transport, we have this avoid, shift, improve approach. We want to first actually reduce the energy demand before we look at electric mobility as a change in the drivetrain technology. And so we can see opportunities across this whole chain of avoiding unlimited, unnecessary trips, etc., shifting more to public transport and sustainable modes, and then doing the actual energy transition in the transport sector by shifting the drivetrain technologies. And so if we look at also avoid, this also means something like empty trips in the freight sector, they can be avoided. So we're also looking at better management services and this kind of service sector for really improving our database and understanding how trips can be pooled, etc. And then, of course, there's everything along the electric mobility supply chain ecosystem. So this includes the charging infrastructure on the one hand, and here, of course, it's not just about technology, it's also about services. What about smart charging opportunities in the future, grid integration of electric vehicles, storage you mentioned. So all these matter a lot, of course, but it's also about the battery itself. So battery manufacturing, and then second life use of batteries, as well as the whole recycling of batteries, of which there will be much more in the future. I think these are still early markets, and we're doing some work on that, but I think this is a great opportunity for India in particular to look into this sector of battery, second life, and recycling. And then I also wanted to mention that, of course, the manufacturing itself of electric vehicles and the services that go around it, as some of the examples.
Right, I think we have seen some very large investments come into additional companies that have spun off their electric vehicle arms. So absolutely right. Millie, if I might turn to you from a buildings perspective, what other business opportunities?
Yeah, thank you. And, just taking a step back, because I have been in this space for a very long time, close to 3 decades now. So I really have seen the green building space evolve and the business opportunities that have been created around it. So buildings have a very large footprint, as we know, like 40% of emissions. And we talk more about the emissions, but then it also has a very large impact on the water footprint, on the spaces that are created and the people who occupy that spaces, on health of those people, and the material that goes into building construction, because they are there for a very long period of time, the embodied carbon content, and so many other aspects, the waste that is generated. So when green building as a holistic or as an integrated, concept, it came into being through certifications such as LEED, which is something that I steer, kind of at a global level. So what we saw was that knowledge around what technologies and what concepts can do to transform this sector to be saving on energy, water, and other aspects, that led to a lot of businesses, kind of upping their game in the whole thing. Just to give one example, like we know energy has one of the major, contribution to the emissions. And when we started the journey, the suppose ASHRAE code is something that you refer to as a base to drive energy efficiency. But from when we started to now, say 30 years hence, it has even been more stringent by 20 to 30%, which means that if you make a code more stringent and if that get applied in a certification program, and we are also trying to compete to be better than the best, then the technology and businesses also have to meet up to that demand. So there is humongous amount of businesses, that has been transformed because of this sector. To take a few names, the lighting industry, the air conditioning sector. And these are all dynamic. It's not that what we started 30 years back is the same. They are all dynamic and efficiencies are getting improved every year. The whole space around controls, water efficient fixtures. Then this whole space around the indoor environmental quality, around, the acoustics, around daylight integration, like the glazing industry, for example. They have completely transformed how you make glasses that can keep the heat out and allow the light to be in. So like this, there are several transformative technologies. And now what has happened is that you are moving towards, zero, net zero, you call it real zero, net zero, whatever it is. But we are trying to be, kind of be zero on the emission side. So here, even there's more challenge, on the embodied carbon side, on the technologies being more and more efficient.
By embodied carbon,
renewable-
you mean steel and
the
cement?
steel and cement and other sectors, dematerialization, how you use the waste back into the building, the entire circularity. So the businesses are again kind of revamping them up to meet the challenges. So there are a lot of opportunities I see.
Great. I'd love to hear about a few of the company names, but Manish, first to
Yeah.
you.
So we are into climate finance sector. And what we have seen is that currently new opportunities are coming firstly in the energy storage business. Because, renewable is going up and beyond a point, they'll make grid unstable. So there's no option but to invest in energy storage. We are seeing investments coming in pumped hydro, which is a very efficient energy storage. We are seeing investments into the battery systems. And green hydrogen is still nascent, but a lot of activities we are seeing. The other area where we are seeing good investments coming up is in the supply chain. Because of the PLI scheme, model manufacturing is picking up. And hopefully at some point, India will become self-sufficient. So this is on the renewable side. On the electric mobility side, the segment itself is new in India. We are seeing a lot of activities around the two-wheelers and three-wheelers. On the total cost of ownership, these two are viable today. And so are electric buses and passenger vehicles if they run at least at 200 kilometers per day. There again, we are seeing exponential growth. So these are the segments we are seeing large investments. And hopefully the other sectors will also come up soon. That's what I would like to say.
Yeah, and you mentioned the total cost of ownership. I think the interesting factoid for everybody here is that there is actually no energy subsidy, at least on liquid fuels in India, the transportation fuels. In fact, we have $140 to $240 per ton of carbon equivalent carbon tax or price, which is really there not for, it's an implicit tax, implicit price, carbon. It's not really there for carbon purposes, but it's to raise money for the exchequer, which then goes into education infrastructure. But it's $140 to $240 a ton. Just compare that to $80 of European carbon tax or carbon price at this point of time. It's 2x as much. So indeed, those technologies are in the money for that reason. So great to hear that. Maybe one follow-up question before I move on. Your group, Tatas, have taken investment in a number of incumbent companies from which they've spun off clean tech businesses. You look at Tata Power Renewables, or you look at the EV part of Tata Motors, where large capital infusions have come. how do you see the value creation dimension from these new businesses that are newer business opportunities?
So I think value creation will happen faster than we think because, as we discussed on total cost of ownership, already this segment is profitable. We are mainly into four-wheeler and the electric buses. Now, what's happening is that the supporting infrastructure that has lagged behind, the charging infrastructure, but that is developing very fast. And once that develops, which I expect to happen in the 2-3 years, I think there is going to be some kind of a disruption in the sector.
My question is slightly different, right? Investors have paid, your investors, for example, are paying large multiples on revenues that don't exist. So why is that value creation? That's the question I'm asking.
So actually, they are paying because of the future value they see. The way we see the international forces at play, clearly it's a matter of time because technology is there, the government support is there, and technology is only developing. So clearly, we expect that disruption to happen very fast, and that's where the investors have taken a call, and that's why we see the huge multiples. It's very futuristic, though.
It is futuristic, so expectation of growth is what's driving this, and profitability at the same time. All right, wonderful. Chanaka, your views on the opportunity coming as you do from Sri Lanka.
So perhaps for a bit of context as to where I'm coming from, Sri Lanka is going through a very comprehensive reform of its energy sector, starting from changing the act to be more private sector oriented and competition friendly, to unbundling a vertical utility into its various constituent components. And that creates a whole heap of opportunities. We were talking a little bit earlier about privatizations of discoms and all the lessons that India has learned over the years. So I think the opportunity here is also about, for the global South, countries like ours to be able to leapfrog over the mistakes made by both the global North as well as countries like India, which means it creates opportunities that hopefully are less risky. They encompass the lessons learned. There are other opportunities also that arise in the context of countries like Sri Lanka, which is, for example, we sit on some of the best offshore wind resources in the world, far in excess of what Sri Lanka would ever need. And interconnection, which is on the cards, by the way, creates a whole gamut of new opportunities surrounding that. It opens up, widens energy markets for investors, and I think interconnection is going to play a key role for all countries in the global South. Manish referred a little bit about areas like green hydrogen. So all these offshore wind resources are key towards unlocking that potential. The simple reform process and interconnection in itself can drive fairly large, chunky, scalable opportunities that will attract investors. Of course, there are a whole heap of challenges associated with that, but we'll talk about that later.
All right, I'm going to shift gears and try something. So if all of us can be disciplined on this one and give me each of you quick 2 sets of challenges that you see for this private investment. Then we'll go into some of them in more detail. But I'd just like you can just throw out the top 2 challenges that you see. It may be sector specific or product specific, but love to hear whoever.
Okay, so I'll take that. So the biggest challenge we see is the health of the public utilities. Most of the output is purchased by the public utilities, and their financial health is a challenge.
So buyer health. Second one?
The second one is enforceability of contracts.
All right.
I think the risk-return architecture in every sector is sometimes weak.
Okay.
I would like to bring in skilling, so the skills for these new technologies, but also regulations and standards.
Regulations and standards.
Implementation remains a constant challenge, and monitoring and measuring performance and tying it back to design, that remains a challenge always. And of course, the skill part of it, you know, lack of appropriate uh, people to service the sector.
I mean, for us, it's also about lack of scale and lack of regulatory
Scale,
and
lack of scale. you
lack
said.
of scale, yeah, and lack of regulatory and technical capacities.
Right. So if I just resynthesize some of what you've said, there is counterparty related risk, contracts, discom health, whatever you call it, right? Because many of these sectors or product categories or industries that are being created don't have economic products yet, or they have products that are, they're like infrastructure. Sometimes the products don't have the ability to sell themselves. They have to be sold, and therefore the counterparty risk. We heard about skilling. Several of you talked about that, scaling, which is also linked to implementation. I think scaling and implementation. Um, regulations, and because many of these sectors do start with regulation, right? So when you did your first solar project, the regulations weren't favorable. Neither was technology price points at that point of time, but over time that changed. And then this all comes together in a risk-reward ratio for a particular business. So that's a bit of what I'm hearing you all say. Let's pick a couple of these and tease them out and talk about what might be solution also, right? And what is the real challenge? So maybe let's start with the risk-reward one and
Yeah.
tease it out a little bit.
So the overarching, I attended the last part of the previous session where a lot of good things were said about how good the IRA. But one of the consequences of that act is the threshold becomes even more difficult to attract international capital in emerging markets because of all the good subsidies that's been given in the US. So I'm not saying the solution is always international capital. Therefore, it's very important for countries like India and other emerging markets to really develop their local domestic resource mobilization. If you want to attract international capital, apart from all the sector level, which Manish talked about, whether you talk energy, e-mobility, contractual, tariffs, all of that, you have to layer that and go an additional step of factoring in macro risk, political risk, and these three additional risks an international investor will definitely look to hedge before they get deeper into a sector level or a project level. That they have to, there's no escaping that. So in order to attract and put all of this together, there is a role for blending multilateral or concessional finance or risk capital during the initial phases of a sector and making sure there are enough strings attached so that the road to sustainability of that sector is achieved in X amount of time, let's say 5-7 years of time. Till that time, you need some temporary support. That's where Mr. N.K. Singh might have talked about the MDB reforms and how multilaterals come in, how blended finance structures can come in as temporary subsidies or temporary kickers or temporary sweeteners. But the difficult part is how do you attach strings to it with the government regulation so that over time it is self-sustaining. And we can talk different sectors. There's no silver bullet. Electricity, mobility might have its own set of issues. Power sector will have its
Give
own
us
set
an
of issues.
example of.
Yeah, so an
one
example of
real-
that is when the solar thing started initially, let's say in India, we started that using concessional finance, grant money to set up the first demonstrable project in India. It was in Tamil Nadu, 5 megawatt and so on. But we had, in the meanwhile, that started the whole thing. In the meanwhile, there was a roadmap that India was trying to develop, obviously with lots of fits and starts. Everything was not planned like that in 2005. So it fell out like that. The roadmap was that over time, with scale and with manufacturing ecosystem, prices will come down. Similarly, now in the green hydrogen, given all the lessons in electricity, that's what we are trying to do. The government is starting with a subsidy program of $1.5 billion to fund all of this, create the demand and so on. The expectation is that maybe in 5-7 years or 10 years on the hydrogen side, maybe in 5-7 years on the battery side, the prices will come down to a point that it's commercially viable. But will we wait for 5 years? How will it develop? It's a chicken and egg. You set up something today to demonstrate. You create demand today so that the scale drives the prices down. Yes, that's where the concessional finance, the blended finance, the risk capital comes in. So you start doing some of these projects. One of the lessons from renewable energy, which is, I think, applicable, and we did a study even on the hydrogen side, is instead of starting from hydrogen production, let's start from electrolyzer manufacturing. Build that piece today, get the countries, especially in India, have that capability. Otherwise, we're going to run into similar problems as we ran into solar and wind in between after 10 years of journey, is the supply chain there? Are you immune? Are you safe? So why don't we start this time around by looking at electrolyzer manufacturing also, so that there a viable road to sustainability. Similarly, on electric mobility, what are the critical pieces? Is there a mineral shortage? Is there on the OEM manufacturing? Whatever it is, let's sort that
So
out.
you've talked about many aspects of both solutions and consequent or barriers that require solutions. One is when the business is not viable, right? Grant funding or some forms of subsidized funding. And then the need for a roadmap at that point of time from the government. I was also involved somewhat in the solar mission. I remember that creation of some of that roadmap. Then the technology costs came down, largely driven by scale and implementation from China. 2013, 14, maybe 18, we started saying, look, as generated, the costs are very similar to coal, parts of our coal fleet. Not all of it, but parts of our coal fleet. And so on, right? So that's it's a 15-year journey that we've described here, right? And the question, of course, on all of this is that do we have another 15 years
How
and
do we
15 more and 15 more for
Yeah.
hydrogen and the next thing or not? So it's an interesting set of points that you've raised. Maybe, Manish, I'll turn to you on the contracts point and the counterparty risk as well as offtake agreements, right?
Sure.
In green ammonia, green hydrogen, also in areas like BESS, there's a whole sets of conversation around these topics without which businesses can't make. What's your view on those?
So I think when it comes to the enforceability of contract, the most important step we have to take is to improve the health of our public institutions, DISCOMs, state transport undertakings. Now, this was difficult a few years back, and various things were tried, like Uday scheme and so on and so forth. But today it is not that difficult. Today technology is there. Technology has significantly developed, and today, as we speak, the commercial and technical losses in India have come down significantly, already from 20 to 23% to 16%. It can probably come down to 11%. So today, if there is a will, and we are seeing that in a lot of steps which government is taking, then the health of the public institutions can be improved significantly. So that is something which needs to be done, because that is one step which can make a paradigm shift. That is number one. Number two is, as Shalabh said, that in the interim, we need institutions like SECI, who can act as a counterparty where the developers have confidence that these guys will not default. So that kind of thing probably needs to be done in the other segments as well, like electric mobility and green hydrogen. I think that will make a major shift. The other area of concern has been, some factors of production like land. So today, if you see, India has got some 80 to 90 gigawatts of successful auction, which has not got converted into projects. Piddly, we have 15 gigawatt of installation per annum. I think the key reason is that project execution in India still has that usual difficulties, land acquisition, and many times policy inconsistency as well. So I think those things need to be addressed. Once we do that, then I guess the execution can be much faster. And on the enforceability of contracts, we do have a good legal system, and in the past, issues have happened. And because of the verdict which courts have given, I think going forward, it will become more difficult. But one more thing which needs to be done in that area is, reforming this state regulatory authorities. The way we select the members of those authorities. I think a lot of work is going on there. Once that is done, then things can become much better.
So
I think a quick one on Manish on the court system. I think the less we go to the courts, the better. We should have an arbitration system. That's more important.
SERC, we have a CERC. SERC is very important. Yeah.
I wanted to pick up on this thought of scaling, right? So in the building space, we've seen LEDs pick up. Obviously, costs came down, but it also scaled very quickly. I'm sure you've seen in other spaces scaling happen. What are solutions that you have seen that have led to?
I think there are, particularly in the building space, and to the point where I spoke about implementation challenges. So the scaling also happens as from two aspects. Like one is, the consumer pull around the benefit of a particular type of construction, which they know would save. And the other is from the regulatory side. If there is a push and there is a regulation, which is driving, such constructions. Now, what we have seen in this sector is that particularly, scalability in private sector where the occupiers of a building are somebody, who are constructing it and who who are actually reaping the benefits of their own investment. There is no particular challenge. They do it once and they repeat it all through. Particularly, the scaling challenge comes in the real estate, the developer driven construction, where the developer does not reap the so called, initial higher investment which they may need to put in, and they are always on a lookout for incentives. So scaling happens when there are, adequate incentives. Again, we have seen these incentives also being, counterproductive. I'll give you one example. There is this prevalent incentive from government on giving extra floor area for green buildings, depending on the rate of green building that you achieve, whether it's gold, platinum, 1 star, 2 star, 3 star, you get more and more floor space. So on one hand, you are trying to scale up by giving incentive to developer, and you are also adding to floor space, which is, taking away from all the resources that you have saved. So I would say, it is a factor of this push pull that happens in the sector. And we have seen a lot, a lot of sensitization awareness that is needed to sensitize the sector and particularly the consumers to have that pull and to drive these. So scaling happens from not so much from the sticks from, but more from, their own willingness to do it. We have seen more in the sector.
Maybe I could add from transport side, of course, what we've seen in India with the aggregated tendering for electric buses that have been implemented here, really pooling different cities' demands for electric buses, I think has been an innovation from India that has caused a lot of interest from other countries in Asia. And I think it's a very interesting case for creating scale, at the same time bringing down the cost, obviously. And so I think government, of course, has a very strong role to play in promoting scale. There's regulation. We mentioned regulation as a problem, but we also advocating for including charging infrastructure in the building bylaws, for instance, to just make it a requirement, and then thereby also creating demand, obviously, for, in this case, charging infrastructure. And coming back to the question of risk, maybe another angle, I think it's really interesting development also on the electric bus space, the new fund that is being set up here in India with a guarantee for the manufacturers that they will be repaid on electric buses, because there's been problems with delayed payments in the past, even for conventional buses by the operating side. So setting up this fund as a payment guarantee that would allow larger scale investments and more interest on the side of manufacturers, I think is very interesting.
Equivalent SECI for buses. Wonderful. Let me pick up on one of the other things that came up, which is cost reduction. Right? So all of these technologies more or less start a very high cost. They're more expensive than conventional technologies, and some reduce down to the level where they become very competitive versus existing technology. Renewables and solar is one of them, at least for against parts of our world. What's needed for that? Scale is one of the things that helps, but what else? What have you seen?
So I think one of the structures that India has experimented with, which is the INVIT structure, where once an infrastructure project is operational, you put it in an INVIT and you recycle capital by attracting cheaper sources of finance to finance. Much more of that is needed, which is basically essentially securitization.
That gets cost of capital down.
That gets cost of capital down. That gets less risk, more risk-averse investors into the picture.
Right kind of investor.
Right, and you free up the capital of lenders who can do more greenfield, and all this.
Yeah.
So that we can do much more. That's another angle to it.
So basically, the nature of technology is such that the capital cost is very high and the operating cost is very low. So naturally, the cost of capital plays a very important role. So whatever we can do to reduce the risk of the project will reduce the cost of capital. So I guess, it has to be.
What about the hard part of technology itself?
Yes.
As you invest, what do you see? Do you see people pushing really hard, and what do they do to get the cost of the panel, the cost of balance of plant down?
See, actually, if you take solar, then the industry was lucky that when they were scaling up, the cost was coming down. It went up in around COVID time, but again, it has come down significantly. As far as technology is concerned, globally, I think in solar segment now, TOPCon models are coming, HBT panels are coming, but they will decrease the cost only incrementally now. I think here, because the capital costs are high, cost of capital plays a very important role. It's 3 to 4 times debt is used than the equity. And of course, equity also has a cost. So as Shalabh was telling, some structures to reduce that cost of capital.
Yeah.
Basically, you reduce it by reducing the counterparty risk. That is
Correct.
number one, which
Yeah.
is the off-taker. And then the structures which can diversify the risk. And third, which was discussed in the earlier panel also, if we can find, maybe it is not very important now, but eventually, the foreign capital which will come in. The problem is the hedging market in India is very shallow. So, even if it comes at 2%, sometimes actual cost is 12 or 13%.
No, it was, you're right, discussed in
Yeah.
the finance panels earlier in the day. Let me go to the last one that was raised around skilling. Love to hear what needs to be done on skilling.
Well, again, in the Sri Lankan context, and we're probably not unique in this, the cumulative opportunity in itself is small. And then when you start fragmenting this across individual opportunities, it's hard to get investors out of bed. And so one thing that needs to be done is bundle these into opportunities that make it attractive enough. And then what happens is you start entering the risk of or the fears of regulatory capture or elite capture or whatever it is. And rational or not, these fears can still be addressed by robust, independent regulatory structures. So that's why the capacity building on that side is so important to unlock this challenge of lack of scale. On the risk and the cost of capital side, you're absolutely right. And I come from a country that is just winding its way out of a default, and the cost of capital is very high. So it's all about ring fencing, perhaps, the energy sector out of the risk associated with that high cost of capital. And I think there are models and success stories out there. If my reading is right, I remember how Argentina managed to sort of ring fence its financial energy sector off away from the sort of sovereign risks and actually raise capital cheaper than the sovereign did. So it's possible, and it's all about creating that architecture. And I was happy to hear yesterday about the multilaterals reforming themselves, hopefully to unlock some of these.
All right, we
risk
seem to be
mitigation
out of time. Do we have time for questions, or can somebody tell me whether we have time for questions? No? We're out of time? There's one question I'll take, if you don't mind. All right, go for it. The gentleman in the corner.
Thank you so much. It was a very wonderful panel, and it was a pleasure and honor hearing you all. My name is Shivam. I have completed my graduation and I'm rightly preparing for Indian Civil Services.
What's the question?
My question is to Millie ma'am. Ma'am, you so wonderfully explained about those green buildings. And I think the way for net zero planet can go through a net zero homes. What is the problem which is exactly coming? Because ma'am, even if we see from the state side, so there's a whole lot of construction which is done from the state side also, like through various
Okay.
housing society schemes.
You don't need to illustrate it. I think Millie got the question.
Yeah,
I'm
yeah,
sorry,
yeah.
I'm going to cut you off. Millie, go for it.
So, yeah, I mean, when you talk about net zero, it is not, you cannot generalize it, right? So, from the home side, again, you have to see whether you are trying to make net zero on operational or the whole, building. So, and most of this economically weak section housing or low income housing, they do not have so much of operational energy as much as embodied. So, I think we have to look at, expand the scope of how we define net zero, and then look at holistic savings. But I can talk to you offline on what are the things
Yep.
that are happening, and there are a lot of initiatives that are currently being undertaken by government.
A last quick word, Shala.
So on scale, I think we take it for granted, but government's intervention for creating world-class infrastructure and driving the logistics revolution is critical, because unless those costs come down, manufacturing will not be competitive. If manufacturing won't be competitive, a lot of the other climate industries won't be competitive.
Wonderful.
That is critical.
No, good. So let me just synthesize some of what we heard today in terms of, we said there's a large capital revolution. We talked about the fact there's value creation, large number of companies and businesses to be created. You all illustrated many such businesses. I also heard 7 or 8 things which will make these businesses successful. So some I heard, some I'm making up. To me, there are 8 things, right? So there's one, companies and businesses have to start with game-changing ambition, right? So many things won't be clear, but you do still have to have a high ambition, and we've seen that test. Second, technologies, because the technologies are shifting. We didn't talk about technology That's going to be important in being able to pinpoint and pick the right one. The third is securing cost advantages. We talked about that quite a bit. Fourth is signing up captive demand early and assured demand, right? We talked about counterparty risk there. Delivering factories at low costs. Many of these factories are being built for the first time, second time. When they're built for the eighth time, they can be done at a much lower cost. Procurement, whether it's for your equipment or it's for renewable power for a hydrogen, right? So procurement of batteries for an automaker. Low cost financing, we spent a lot of time on that. And maybe finally talent in general, right? Skilling what represented. So these are 7, 8 things that are crucial. Thank you, panel, for the time, and sorry, organizers, for running over a few minutes. Thank you, everyone.